Hello and welcome to another video on my YouTube channel. My name is Joris and today I am here with a video about 3A pillar investing and the website 123pensionierung.ch. I believe it's a really good website to explain everything around your pension. And why I'm making this video? Well, I received a question from Ride with Chella. Please do a video about pillar 3A investment, and I looked at it. It's already way back in the days, the 13th of September of 2024, when I made the last video about 3A pillar investing here in Switzerland. So I said, thank you for your suggestion. I will do that soon. And I wanted to do it before the end of the year because it's really important that when you have the money, when you can save, because I also know that saving is hard. I will put a link to the previous video about 3A pillar investing and also my last video edition of Saving is Hard here in Switzerland in the description down below. So check those two videos out. And just briefly about the pension system in Switzerland. So you have the first pillar, the HV from the state. Normally when you are earning money here in Switzerland, you need to contribute when it's more than 22,000 and a bit. You need to contribute towards the HV here in Switzerland. And when you are employed here in Switzerland, your employer is also going to contribute towards a pension fund. So you are going to contribute a certain percentage of your wage, and your employer is going to give you a match. So it's more or less like the 401k in America, where you contribute to investment accounts and then your employer is giving you a match. Here it's most of the time 7.5% that you contribute and your employer is going to give a match of at least 7.5%. Sometimes it's 9, sometimes it's 11%. It's to see where you work, how long you're already working. But together those two pillars should provide you with 60% of your last salary when you are retired as a pension. But it's a huge but. You need to have worked 100% for your whole career. So, and your whole career, that is 44 years from your 21 years old till your birthday of your 65 years old. So, not a lot of people have done that, worked 44 years for 100%. And like this, your HV will not be the highest amount possible. Another thing is, a lot of people don't realize that, but for receiving the highest amount of HV, you don't only need to have worked 44 years at 100%, you also need to have earned, on average, over your whole career, 90,720 Swiss francs. In my previous video in which I talked about this, I got the 45 years wrong because it needs to be 44, and I said it's about 80,000, but it's not 80,000 anymore. The 80,000 was a few years back. Now it's 90,720 Swiss francs that you need to have earned on average during your whole career. So that's really crazy. Not a lot of people realize that, but that 60% that everybody is having in their head, because everybody says it. It should provide you with 60% of your last salary, but it is not going to do that. When you're married, you can together you can only get 150%. So you 100 and your wife then 50%. So that's also, that's the punishment of being married here in Switzerland. They want to adjust that, but they already trying to do that for a lot of years and they are not getting there. And then, of course, my wife and I, we are in this situation. We are not going to have worked here 44 years. We first worked 15 years in Belgium, and then we moved here to Switzerland. So we will not get the full HV for sure. And also our second pillar will not be as huge as people that are working here already for 44 years when they go in a pension. That's just the way it is. We know that. So for us and for a lot of people, it's important to also do 3A pillar investing here in Switzerland. That's you have to do it yourself. These two go automatically normally, and this one you need to do, and then you get a tax advantage when you do. You can invest towards a 3A pillar account, and that is what I'm going to discuss here. And you can also invest towards a 3B account. I'm not going to discuss that here. I don't have any knowledge about 3B investing accounts. And we can save more money than the maximum amount that we can contribute towards our 3A pillar account. But we are not contributing towards 3B account. We are doing the 4 pillar, and that is also you yourself without a tax advantage. Because yeah, this money, at least when we want to access it, we can sell and we can use the money without a tax disadvantage. Here, when you want to use the money, you most of the time have a disadvantage tax-wise. There are exceptions, but more on that later. So you have 3A pillar options. You can go for a pure savings account. I'm not a big fan of that because you have a lower return and okay, it has less risk. You know, the bank gives you right now it's 0.15%, so it's really low the amount that you get. Sometimes you get 0.80%, so you have to shop around a bit. And I won't advise to do a pure savings account when you have more than 8 years of time horizon. When you have less, this is a valid option for sure, because you never know what is going to happen on the stock market. But when you have more than 8 years of time horizon, you should go for an investing account. In what degree you go for 20% saving, 80% investing, that's up to you. You need to talk to your bank or your insurer about that. But yeah, an investing account, it always comes with a higher risk and a higher return. But yeah, you need to have a larger time horizon, so at least 8 years. So you can go for a mix of both in a certain percentage. Just talk to your bank or your insurance company. You have a lot of options, but just be certain you get a tax advantage and the bank and the insurer are going to profit from it. Sometimes you can profit a little bit as well, but yeah. The thing is, the tax advantage is huge enough to compensate the fact that yeah, Swiss Life, UBS, all the other banks, they are taking a part of your profit away and putting it in their pocket. That's just the way it is. Every time when something is too good to be true, it is too good to be true. And you can also go for an insurance account. So you also have the same options as with the bank, and you can take a life insurance on top of that. That's something that I didn't mention in my previous video about 3A pillar investing. There I talked about using your 3A pillar account as a way of amortizing your loan for your house. Well, normally your bank will want you to have a life insurance as well. And when you already have a 3A pillar account, investment account with an insurance, with a life insurance, you don't need to take an extra life insurance. It's good enough for the bank that you have a life insurance with the company where your 3A pillar account is. So in that way, yeah, it's an extra cost, the life insurance for a 3A pillar account. It's not the best, but on the other way, when you can use it for amortizing your loan, you are getting a life insurance plus it's tax advantaged life insurance that you get. So when you take it with your bank, it's separate from your 3A account, and then you don't have the you can't subtract that amount from your actual income. And that's what you can do when you have your life insurance as a 3A pillar account. And then you need to realize that you are taxed when you withdraw your saved money at a reduced rate compared to your taxable income rate. And it can also be interesting to have multiple, so 4 or 5 3A accounts, so you can spread and reduce the tax burden when you start and take up your 3A pillar accounts. But I'm going to talk more about that later because some people forget about an important thing. But more about the maximum amount first in your that you can contribute towards your 3A account. As a private person, employed person, so me and my wife, we are employed persons, we can contribute maximally 7,258 Swiss francs per year. If you are self-employed, you can maximally contribute 36,288 Swiss francs per year. But you should remember that you can only contribute maximum 20% of your total net income. And in this way, you should have the number 181,440 Swiss francs in the back of your head, because if you earn less, then you need to calculate the maximum 20% of that amount. When you earn more, it's always going to be 36,288 Swiss francs. A lot of people here, when they are self-employed, they don't earn that much. The people that are fortunate enough to earn more, well, that's the maximum contribution that they can do. So now more about the advantages. The tax advantage, I already mentioned that. So you reduce your taxable income by contributing towards your 3A pillar account. And when you start taking out the money from your 3A pillar accounts, so from the moment you get 60 to 65, you can start to withdraw the money. You get a reduced tax rate here in Switzerland. I think it's 10%. I don't know yet, and I think it's going to change when I'm there. So we still have 22 years to go before we reach our retirement age. And yeah, it's uh, it's a good thing that you can do that. Of course, you when you save on the tax that you need to pay on your taxable income, that's such a huge advantage. It's incredible. When you start saving for your 3A pillar account, the year after you need to pay less taxes, and that amount you can immediately put aside towards paying your next contribution for your 3A pillar account. So in fact, it makes saving year after year after year a little bit easier for reaching the maximum amount in your 3A pillar account. So when you are buying or rebuilding a house, you can use the money for this. So then you have the option to withdraw your money earlier. You can also use your 3A pillar contribution as indirect amortization of your mortgage. If you want to know more about that, go and check out my previous video about 3A pillar investing. There I had, at the end of the video, normally I have timestamps. You can immediately go to the timestamp where I talk about using your 3A pillar account as an indirect amortization for your mortgage. And an advantage that you have is that you can't touch it. So until you're retired, or not earlier than 5 years before reaching retirement age, or until you start a business or buy rebuild a house. So also when you start a business, you can withdraw your money earlier. But yeah, it's an advantage because you are not tempted to sell it because you can't do that. And not being able to touch stuff is really good when you know how compounding works. And it's actually also a disadvantage. In my previous video, I mentioned that, but now I'm not going to go on about that. I'm going to go to the website of 123 pensionierung.ch. I think this is a really good website explaining everything about pension. They have a section about the 3A Säule, so Säule 3A. They also have a part about the taxes and your pension. They also have a part with online calculations and way more. let's check the website out. So when you go to the website, it looks like this. And here you can see already rente or capital, you have pensionkasse, you have ASV-rente, Frühpensionierung, saldo 3a. Here it's actually the most important thing, so you can go to the overview of your 3a, and there you immediately see what the maximum amounts are, and also they think that in 2026 it's going to remain the same. So in 2027, normally the amounts will go up, and yeah, it's a company. Don't keep that in mind. So don't click on links that you don't want to click on. But another good thing is, where can I find that? It's here. So when you want to withdraw your 3A account money, here you can. They also say that you can, yeah, spread it out. So when you have 2 or 5 accounts, they give you a calculation here. So you spread it out over 5 years, withdrawing 50,000 every time compared to 250,000 in one go. So here you have to pay 14,900 Swiss francs when you withdraw it in one go, and then here you only have to pay 11,500. So you save more or less, yeah, 3,400 you save when you withdraw it in 5 times, but more on that later. And another important part is here the online berechnungen. Here you have all kinds of calculations. So also if you need to go for a Saron or a Festhypotheek, just keep in mind when you go here and you look at the numbers, they are not correct. So Zinsatz, the Festhypotheek 2%, it's lower. Aktueller Zinsatz Saron Hypotheek, right now it's less. You can also see here amortization of your mortgage. You can simulate your second pillar. So it's a really good website, and I like it a lot. But yeah, it's important that you realize that this website, it is a company. So I like the website because it's a really informative website. Don't click on links that you don't want to push, because maybe it sells you stuff. I don't know that. I haven't seen it so far when I'm on their website, but you never know, so be careful. You have plenty of other websites with information like finpension.ch and a lot of others, but none of those others are actually as informative as the website of 123pensionierung.ch. And is it really necessary to have 5 accounts and reduce your 3A savings plan with 3,400 Swiss francs in taxes? So 680 Swiss francs per year. Is it worth it? For me, it's only worth it if you only have accounts at a bank that bring less than 1.36% per year. And that is even without accounting for the compounding effect. So when you have 5 years to go and you withdraw when you are 60, and you have an account that brings 136 or less, you have to also account that if you let it compound at 1.20%, it's going to bring you more than 680 Swiss francs. And that's the savings that you have when you do it in five consecutive years. So is it worth it? I don't believe so. So a lot of people overestimate the tax benefit that comes from withdrawing it in 5 times, and they underestimate the compounding effect that your money has when it's on a savings account that brings you an interest rate. Okay, I know now the interest rate that you get on a 3A savings account is really low, but will it remain this way? And will it be that way when you are at your 60 years old? I don't know that. That's just a thing that you need to keep in mind for yourself. But the thing is, my wife and I, we invest towards an investment account, and normally this brings you way more than 1.36%. And in that way, I don't believe you need to have five accounts and you only need one, because you will earn more than 3,400 Swiss francs in letting the money compound for those 5 years. But not, naturally, hopefully the stock market does not crash just before you take your money out. That's a really nice and important side note on which I want to end the video. So thank you for watching this one. Please hit that subscribe button, it helps out my channel enormously. Hit that like button as well, that helps out my channel enormously as well. And see you on the next one on my YouTube channel. Bye.